what do you need? Correlation?
Correlations. Is there a way to find that on the market as an average person?
I guess I don't consider any of us here average persons.
Well, as a non-broker.
Yeah, no, I know what you mean. But what I would do, if you want that information, you can find it, okay? You can find it directly on a website like the JP Morgan Risk Metrics. Got all the correlations you ever want to see. 30,000 of them or something. Or you can just download the stock return and run this regression. Or run a correlation with the other securities. So you can do that. It's just a button in Excel, right? To get correlation metrics. So you can get all of this. You don't have to be hooked into an investment bank for this. Everything is available. But I think you're correct that it's not maybe generally available for like the average investor. And that may be a reason why the average investor might go towards a mutual fund and let them worry about the organization of the portfolio. Yes?
So that you wanted to do this, how much data would be a reasonable amount?
To get a beta?
Yeah.
5 years.
5 years.
It's kind of rule of thumb. Monthly return, 60 observations. Okay, so...
Yeah. So how does this fit in with your comments before we were talking about other sorts of volatility where the volatility, your expected volatility doesn't necessarily have anything to do with the historical volatility? I would think that would be the same with beta. That an expected beta is really doesn't necessarily have anything to do with the historical.
That's true. So this is actually leads nicely into what we're doing next, and that is to look at the beta through time. Okay, this is an example of IBM's beta, and I've estimated it over various different horizons. One from 1926 to 1995, and then 10-year subperiods, and also 5-year subperiods through June of 95. And the beta's changed. Does that make sense? Yes, this firm is way different today than it was in 1926. And actually, I think it's much different today than it was in 1971. So, I said 5 years is kind of rule of thumb. Yeah, because if you go much longer horizon, then you can be really confusing stuff in terms of having a totally different firm in the equation. Okay, so the beta can't change. These are all historical. So these are all based upon the average, let's say, from 1990 to 1995. And the question is, well, if I'm doing investment, I want beta from 1995 through the year 2000. So you have to be able to forecast the beta. And I hate to keep on saying this in the second year course, but in the second year course, we explicitly put a method forward to forecast the beta. And it's called like dynamic risk function, whereas the risk is the beta. And we want to make it dynamic, change through time, and we definitely want to forecast it. So it's doable. So it's a good point. It's the same as the expected return, the volatility, the correlations, the beta. All of them in finance must be forward-looking. We can learn something about their behavior through history, and it's the case that things are correlated. So high volatility security over the last 5 years is very likely to be high volatility over the next 5 years. A strong autocorrelation in volatility to the tune of like 0.9. There's also strong correlation in the beta, historical beta, because the firm just doesn't immediately shift business lines. It takes a while. So the beta slowly moves through time. It can be affected by business conditions, it can be affected by a number of things, but it definitely will move. And this is kind of what this is emphasizing here. Okay. Let's talk about the interpretation of the beta again, because I notice a lot of people get this confused. In this regression equation, we've got the beta, let's say a beta of 2. And let's say the market goes up by 10%. What do you expect the security to do? So So the market, let's say the market excess return is 10%. The security excess return is going to be, it's expected, and the key word is expected to be 20. That it might be 15, it might be 25, and if we have enough realizations of excess returns on the market of 10%, then they're all going to average over 20. So just because the market goes up 10 doesn't mean for sure that your stock excess return is going to go up 20. It means on average, given a move of 10% up, that the stock will go up by 20. Now a lot of this has to do with the R squared. So the regression for IBM also reported an R squared. And the IBM R squared is in around 40%. Suppose it was 97%, and the market went up by 10%. Your beta is 2. Now, what is the realization likely to look like? It's going to be real close to 20%. And maybe 19, maybe 21, but you're going to be really close. So given a number of draws of 10% returns on the market, it could be 19, 20, 21, 20 and a half. On average, you're going to be 20% with an R squared that's very high. If the R squared starts to decrease, then the relation between these two things decreases. And the R squared 40%, it might be the market's up 10, then you're up 25 on one time, and then 15 on another time, and it kind of will average out to 20. Yes?
R squared measures the relationship between which two factors?
It measures the closeness that the stock moves with the market. It measures, another way of saying this is, let's go up to this equation. It measures the, in terms of the variance, remember I said the variance is the sum of these two things? The epsilon and the beta part. It measures the proportion of the variance that's due to the beta part. So when I say R squared 97%, that means that 97% of the overall variance is due to the beta part. And only 3% is due to this part. So if the market does go up by 10%, then it's really likely that the stock is going to go up by close to 20. That's just the definition of R squared. And maybe in a way that you didn't get presented in the statistics. Right. Okay, what else? There's IBM. Oh, also notice that the alphas for IBM are pretty small. And the T ratios, you're looking for a T statistic of greater than 2 to be significant. And in all these 5-year periods, at least, the T statistics are quite low. Remember, the alpha measures the part of the return that's not explained by the market, risk-adjusted market. So this is kind of the expected return given the risk. This is the actual return, and the alpha is kind of the difference. According to the capital asset pricing model, that alpha should be 0. And when we actually estimate it for IBM, it is close to 0. And there's only a few cases where it's greater than 0. Notice that in the overall period, the alpha has a T ratio of 4.3. But this is a trick of classical statistics. That with more observations, you're likely to get significant numbers. And this has got it's got 800 observations. And so I don't think I trust this number that much because I know the beta is probably shifting through time. So I probably put more trust in the 5-year samples. And the alpha is almost always insignificant. Okay.
I'm a little confused on how they determine how much is due to epsilon and how much is due to alpha. We're just assuming that epsilon is not significant because everyone knows the first.
Okay. Yeah, so basically the epsilons cancel out in diversified portfolios.
So we're saying it's zero, so whatever we calculate with beta and what we actually get, we said different, so.
Exactly, and also in the regression at least, the epsilon has exactly an average of zero. So if you took your residuals from your regression, you took the mean. Anybody ever done that? Take the residuals and then just took the average value of those residuals. You get like 0.00, like go as many places as you got. It's exactly zero by construction. So that's just a way the regression is actually done. Oh, the other thing, now that we're on the econometric side, what is the correlation? Remember I said that the volatility on the left-hand side is just the sum of the volatility of this part and the volatility of this part. And that's kind of like saying the variance is just like the sum of the individual variances. What are we forgetting here? The variance of x, variance of y, plus the what? Covariance? You're taking the variance of two things, then there's a covariance, right? And I totally ignored that? Yeah, well, that's the point, that they are. So the second regression trick you could do is to take your residuals, take the mean, you get zero. Take the correlation of your residuals with your independent variable, exactly zero. So two things that you could do. That's why I ignored the covariance. So it's just the variance of the left-hand side is just the variance of this plus the variance of this. There's no covariance. So that's the end of the econometric asides. Portfolio beta. So portfolio beta turns out to be fairly simple to calculate. Portfolio beta is just the weighted sums of the individual betas, and this is the formula for it. So portfolio beta, there's like basically two ways of doing your portfolio beta. You've got a portfolio, it's got returns. You could run a regression of the returns of your portfolio on, let's say, the market excess returns and get a portfolio beta. That's one method. The other method is to notice the definition of the return on the portfolio is just the weighted sum of the individual returns on the securities. And you can pull the weights outside the covariance, and you get that the portfolio beta is just the weighted sum of the individual asset betas. This formula looks very much like the expected return formula. Remember, the expected return formula said that the portfolio expected return is just the weighted sum of the individual expected returns on the assets, right? This just says that the portfolio beta is the weighted average of the individual asset betas. And this turns out to be quite useful because maybe you don't have historical data on your portfolio. You're putting together a portfolio today, and you're trying to choose weights for that portfolio, and maybe a mean variance optimizer. Did you do that in your class, the mean variance optimization problem in the linear programming stuff?
Just started.
Oh, just started. Okay. So you're putting a portfolio together. You're trying to choose the weights, and you're interested in what the beta of the portfolio will be. Well, it's a very easy calculation. It just says that you take the weighted sum of the individual asset betas. Immediately, you know what the beta of the portfolio is. So that's quite an easy calculation. It might be that you're actually told that you cannot have a beta greater than 1.2 if you're doing asset management. So it's very easy to check, given your different possible weights, what the portfolio beta is. Okay? So that's a useful formula. Here's some industry betas. And notice the highest beta industry that I got in this kind of an arbitrary classification of industries is air transport at 1.8. Now, some people also talk about cyclicality. This is like a cyclical stock. And often that means that, it's like the sensitivity of the stock to general market conditions. So the market is up, this stock's really up. If the market's down, the stock's really down as a cyclical. Sometimes it's also referred to as cyclical with respect to the business cycle. So in recession, the stock really does poorly. In recovery, the stock really does well. Well, air transport, in this sample at least, is the riskiest industry. And it's, I think, fairly good intuition behind that it's really cyclical because in a recession, the air transport industry takes the hit on two sides. The business travel disappears or is reduced, and the tourist travel also is reduced. On top of that, they're really highly levered. So they get this classification of being the highest beta. Yeah.
Is this a 5-year sample?
And it turns out that this cyclicality doesn't hold for some other industries. For example, liquor, right? Like in recession, you can make the case that people maybe even drink more. And notice the beta is like less than 1 here. Tobacco is another one that you actually in recession probably smoke more, right? But I'm not sure I want to believe this historical beta. So it says tobacco industry, a beta of 0.8, which means less than average risk. And I'm not convinced. Okay, so here's a case where you have to know when to take the statistics and potentially like throw them out. And this is a case where I believe that the forward-looking beta for tobacco is much higher than 0.8.
They seem to be the most diversified companies, so you'd expect them to be near 1.
Okay, well this is a good point. Okay, so the question is like, how did I do this industry sort?
Right.
So if I'm looking at pure tobacco stock, then there's just no way that I believe the beta is 0.8. Okay, you just need one lawsuit to go the wrong way in California, and the market value is going to plummet. Okay, and so the beta, I believe that for tobacco is 0.8. But we know what some of these firms have actually done. So they've so-called diversified into unrelated industries. Philip Morris into food was not the only one. So, and this is kind of an interesting exercise. That suppose that the beta of Philip Morris is, and I don't know exactly what it is 1. It's possible that, like, how is that possible? The food beta is probably low, right? Because people have to eat, like, all the time. Isn't that much fluctuation. And the tobacco beta could be high. If you put them together, and if it's the case, let's say, that the food beta is 0.5, that the tobacco beta is 1.5, what is the beta of Philip Morris as a whole if we assume that exactly equal wealth is in both parts of the business? 1. This formula for portfolio beta is not just like for a portfolio of a number of stocks. It's also for an individual company. That turns out to be really important insight. And the reason is that one of the uses of the beta is to get an expected rate of return. Because what it delivers, right? Beta times the expected risk premium on the market, add in the T-bill rate, and we get an expected rate of return. And it's an expected rate of return that investors require to invest in the security. And there's a lot of people that are very interested in decomposing the corporation into the various different business units and looking at the required rate of return in each business unit. That presently, this is done in a very naive way, which might seem sophisticated to the novice, where they say, well, the overall firm has got a beta of 1. The risk premium on the market is 13% minus 7. Therefore, the expected rate of return is 13%. And we're going to set our budget targets at 13%. So anybody who exceeds the 13% in terms of the division is going to be rewarded. And if you don't make the 13%, then you're going to be punished. So what's the problem with that sort of technique in a diversified firm?
Well, the hurdle rate is too low for the one that's inherently more risk. They're inheriting the benefit of having other portions of the company that have a lower risk. So the hurdle rate is lower than it would have been if they were a separate unit.
That's a very important insight. So the performance for each division should reflect its riskiness. And we can go in, and I just did this example of Philip Morris, that one part's got a beta of 1.5, another part's got a beta of 0.5. That's going to imply very different expected rates of return. To use one rate in terms of your budget targets or your reward system doesn't make any sense. And it turns out there's a number of consulting firms that have made a lot of money just basically saying those two sentences. Okay, and they've even created these trademark buzzwords like economic value added with a TM on it, EVA. You hear more about this stuff in the second year corporate finance course. And the main idea of EVA is you go into the corporation and you figure out what all the divisions are in the business segments, and you calculate the expected rate of return on each division using the capital asset pricing model or something like that. And you form your budget targets based upon the expected rate of return of the model, rather than having one global number. And the idea is that it is true now, if this manager exceeds what's expected by the market, then you're going to add value, you're going to add shareholder value. That's going to push the price up. That's kind of obvious, right, after this class at least. It's obvious, but it's just a huge opportunity for a number of firms, in particular Stern Stewart and some, every big consulting house talks about economic value added or something like it, some other three-letter combination. Yeah.
So that would also suggest that a company can't, in itself, increase its share price by diversifying its businesses. Because
that's a different question. Okay, it definitely can. If it diversifies.
But can't the market do that as an investor? They can decide what parts of the business.
The key thing is that if you earn more than what's required by investors, so if you're able to deliver a higher return than the risk would reflect, that's going to push the stock price up. It doesn't matter if you're in a single industry or if you're in multiple industries. That is what will enhance shareholder value. Now, you should be careful. There's this other topic that we'll talk about, actually, I think it's the next lecture, that if you just diversify, just for the sake of diversification, into an industry you don't know anything about really, and it's not clear you're bringing any expertise whatsoever, the chance of you actually being able to deliver a return higher than is expected is very low. So often these diversifications that don't bring anything to the acquisition will cause shareholder value to go down. I guess if I own Philip Morris tobacco stock and I want to diversify my portfolio into food, I can do that. I don't have them pay some premium over the market value to force me into diversifying at too high a price. So it's like two separate things going on. But this idea of you must have an expected rate of return that reflects the risk is a really deep idea. Okay? We do this also when we talk about capital budgeting. You do this more in second year course also. In capital budgeting, we did these trivial examples earlier in the course, like here's cash flows 10, 20, 30, 40, and 50. And here's some zero coupon bonds with discount rates, bring them back to the present value. Remember? Well, in the real world, we don't have cash flows like that. Okay, we've got a potential acquisition, and we've got kind of forecasted cash flows. What discount rate do we use to bring those cash flows to the present value? How do we do it? We're not going to use the zero coupon bond rate. How can we get a discount rate? Like, what discount rate do we divide by to get to the present value? To determine, like, I know it's going to cost me a certain amount to invest in this project. I know I'm going to get these cash flows with some probability distribution. So I've got expected cash flows. What discount rate do I use?
The rate of return you're requiring.
Pops rate of the model. The model tells me what the expected rate of return is, given the risk. So if I get a beta of 1, then I'm going to use 13%, according to the usual plug-in numbers that I use. Okay, which could be much higher than the zero coupon bond rate for a government bond.
So going with the logic of diversification, why doesn't KKR split up their company into two? Because there's a lot of people talk about the food stock is worth a lot more if it has the risk associated with tobacco. And the two stocks together probably would be more than what they are now.
Isn't that exactly what they're talking about doing? Yeah. Yeah, no, I think that you're going to see something happen like that. But it's, it's like, it's difficult to make real general statements about that, because often you can go in and you can see that a firm is just grossly mismanaged. Right? It's got like double the staff that it needs. And you can go in knowing not that much about the actual industry, and you can pay a premium and just make some radical restructuring that could enhance shareholder value. Okay, so you have to be careful about doing that. But just the pure diversification without any idea of restructuring often doesn't make any sense. Okay, at least historically, it has not paid off. Actually, the opposite pays off. When you focus on your main business line, you're likely to do a higher return than if you broaden. Okay. So, back to this capital budgeting idea, we're evaluating projects. Now, suppose that we've got a set of projects we're evaluating. Again, I'm picking on Philip Morris, I don't mean to. And suppose that we've calculated the overall Philip Morris expected rate of return of 13%, given the beta of 1. And we're using that to evaluate projects in both the food industry and the tobacco industry. It might be new acquisitions or new equipment, a new plant, whatever. We have to use something to bring the cash flows to a present value. What's going to happen in my net present value calculations? What's going to go wrong?
It's the wrong data.
Using the wrong cost of capital. For which one? Roll. So for the tobacco, I'm using a cost of capital or a hurdle rate that's too low, right? Because the beta is 1.5, it should be higher. And that's going to cause me to accept projects that potentially I should have rejected. Right? We use too low of a discount rate. That's going to increase the value of the future cash flows. And on the food side, I'm using an expected rate of return that's too high. So when I discount the cash flows, it's producing a small number, and it's going to cause me to reject projects that I should have accepted. So this is a real big mistake that a lot of very prominent corporations make in evaluation projects. They make like two related mistakes. first in just setting their budgets and setting their compensation, they often base it upon the overall expected rate of return of the firm. That's the first mistake. And you'd be just surprised if you just look at the letter to the shareholder from the CEO. Often you can see statements like, well, we're targeting 14% return. And any division that doesn't make that is going to be restructured. Doesn't make any sense to me. Because some divisions don't need to get 14, and some divisions need much more than 14. And the second related mistake is that when they're evaluating projects, they use the overall risk of the corporation rather than the risk that's associated with that project. If it's a food project, you've got to use a lower hurdle rate than a tobacco project. As simple as that. That the rate of return that you require for anybody here is related to the risk of the investment. That particular investment. Okay? And there's a way to do it, and I think I've shown you the way to do it. Okay? With the capital asset pricing model or some other related model. Gives you the same sort of thing. So we'll talk about mistakes that are made in capital budgeting, but those are some of the, the real big mistakes. Okay, what else do we have? We have a security market line, which is just a definition. All it is the fitted values from the capital asset pricing model. Okay, so you give me a beta, and the capital asset pricing model gives you an expected return. And this red line just plots what the expected returns are. Notice a beta of 0, the expected return is risk-free. A beta of 1, the expected return is the benchmark return, and beyond. And we also sometimes graph this in terms of excess returns. And just shift the graph down by the risk-free, and then a beta of 1 equals the expected excess return on the market. Okay. Now what about testing the CAPM? Let's talk about that for a little bit, because it's one thing to present a model, and then it's got to have some empirical content to it. So let me talk about the way that this model is tested. And the first way, we just write down the equation for the capital asset pricing model, which is right here. It does not have an alpha in it. So remember, the only thing that contributes to the expected return in the capital asset pricing model is the beta. But our regression equation has got an alpha. So a real simple way to test the capital asset pricing model is to check to see if the alpha is 0. And I guess we did that for IBM and noticed that it was pretty close to 0 over those 5-year periods. Now often what you want to do is not use individual securities, but use portfolios of securities. Because you know that if you look at individual securities, that some of the alphas are going to be significantly positive by fluke, or significantly negative by fluke. Right? So you form portfolios of securities to see if those alphas are zeros, and actually the alpha is, we talked about this before, is just really the actual performance minus what was expected. So people actually did these types of tests, and turned out that the intercepts were pretty close to 0 on portfolios, okay, which supported this idea of the capital asset pricing model. Now, one thing that's important is to notice that these are, or this particular framework is real simple. It says the expected return on the security is a function of one number, the beta. That's a real simple model. So we know that the market is very complex, and to have this model saying that the expected performance is simply a function of the beta of a single number, that's pretty heroic. Okay, so you should keep that in the back of your mind. There's certain things, this is only a model, And this is not like the Black-Scholes model, which Black-Scholes model holds real closely in the market with stocks that are short maturity, like most of the options that are traded. It holds really closely. However, the capital asset pricing model is not as easy to implement. And a number of things could go wrong. For example, I've listed a number of things here. We've mentioned some of these already. The beta could change through time. Okay. Beware of that. The alpha might not be constant through time. Then you could be in a situation where you're looking at the risk-adjusted performance by the alpha, and it says the alpha is 0 for this portfolio or security. But it might be that if you did 2 sub-periods, that in the early sub-period the alpha is really negative, and in the most recent period the alpha is really positive. And that means something. Right? Actually, I prefer to invest in a stock like that versus the reverse, where it did really well in the past and now they're doing poorly. So the alpha is just an average of the performance that was realized minus the risk-adjusted part that was expected. So you have to be careful. It could also change through time. Beware of taking averages. There's also some smaller things like the error variance may not be constant through time. And this is heteroscedasticity. What's that going to do to your alpha and beta? Inaccurate in like overestimating or underestimating them?
They're skewed, depends on which way it's going.
But it could over or underestimate? So inaccurate estimation? Yes? How many agree with that? How many don't agree with that? You have no opinion. This is a test of what you learn in statistics. Given there's no strong opinion on this, it turns out heteroscedasticity does not affect the alpha and beta estimate. It affects the t-statistic of the alpha and the beta. Okay. But that can be important, right? It might appear to be a significant t-statistic on the alpha when it isn't.
Can you give a good definition of heteroscedasticity?
Yeah, well, the usual way is to look at a scatter graph or a graph through time of the residuals. And you might see through time that the residuals are getting bigger. And that would imply a particular type of heteroscedasticity. It's also possible if you just do your scatter graph that you see the deviations from the line, the regression line growing. And that's another type of heteroscedasticity. But in general, that does not affect the coefficients. It affects the t-statistics. And we can take care of that with different estimations. But you should be aware of that problem. The other problem that you kind of learn of in statistics is autocorrelation. Right, you check that with the Durbin-Watson statistic and stuff like that. Also, that does not affect the coefficient. Okay? It affects the t-statistics. So the number 3 and number 4 are maybe not as important as number 1 and number 2. Number 5 could be very serious. Returns may be nonlinearly related to market returns rather than the linear relation that's suggested by statistical models.
That's the problem with looking at it from 1925, or one problem.
It could be there. Could be over the last 5 years also. So what is the beta? The beta is the change in the security return with respect to a change in the market return. And we're estimating that with a linear model, with a linear regression. It might not be linear. So another model would be another regression would be regress the stock return on the market return and the square of the market return. this is a interesting question. What would be that second beta? How would you interpret that second beta?
Somewhat similar to convexity.
Yes. Another word for it. The word is co-skewness. Correlation and covariance. So one is getting covariance, right? The beta, the first beta is the covariance. The second beta is the co-skewness. Yeah, exactly. You got it. So if I put the cube in, that's the I can't even say it. I don't know what happens when you go beyond that, but it's like the sensitivity.
I think it's co-Tylenol.
Yeah. The sensitivity of the market return to a square. Well, I predict in the next 5 years that people will be putting that model right beside the usual model, because I believe the skewness is so important. I got a research stake in it too. So why? Okay. And the market portfolio, this is also an issue. The market portfolio could be measured with error. That we really need a benchmark that people agree upon. It's not clear that the S&P 500 is the appropriate benchmark. It's only like 500 stocks. Maybe something larger is better. And also the S&P 500 is only equities. What about bonds? What about real estate? So there's some issues here that have to do with the actual market portfolio composition. There could be other sources of risk. We've talked about the CAPM, where you regress on the market return. Well, it's also possible to extend this to create a multi-beta CAPM, where you put other things in. So let's say you regress on the market return, you could regress on the change in the price of oil, you regress on interest rate change, various different things that are common to all securities, and you get the sensitivity of the securities return to these different sources of risk, and just like more betas. So be careful. It's probably, in my opinion, unlikely that you can describe everything that goes on with just one source of risk. That a lot of what I do looks at other sources of risk. Suppose you do this regression. You take the stock returns, another question, not as hard as co-skewness. You take the stock return and you regress on the change in the interest rate. Now, what's the interpretation of the beta there? No.
Duration.
Heard two things: interest elasticity and duration. That's correct. Both of them. Okay, so and it's kind of a weird thing to think of. Like we did modified duration and went through a particular way to do it. You know, with all the coupons and cash flows and stuff like that. We got a modified duration, and then modified duration told us for like a 1% move in the interest rate, what was the predicted percentage move in the bond price, right? Right. Well, if I regress the stock on the change in the interest rate, then we're getting basically the same thing, the same information on an equity. So it's like the modified duration of an equity. And I hate to say it, that if we did that regression with a bond return, if we regress the bond return on the change in the interest rate, the beta is just going to give us the modified duration. Okay, so it's just another risk measure. So it's a way to kind of like put all this together in terms of what we did with bonds and now what we're doing with equities. Okay, so the modified duration can be a valid risk measure, except that we need more than one source of risk. Okay, so interest rate is probably the most logical second factor to use in one of these regressions. Yes?
Well, especially with things like preferred stock or any stock that has a high dividend, you've got a relatively regular set of cash flows, so changes in the interest rates do have a big effect on that.
I mean, everybody knows, like just by reading the Wall Street Journal, that if the Fed does something with the interest rate, it's going to affect the market. Right? So that's a real source of risk. So we can get a beta, right? Just that the interpretation of the beta is very much linked to what we did with bond valuation.
What risk-free rate do you use? I mean, is there a world risk-free rate?
Okay, well, we're looking at domestic, but...
Second-year course.
Yeah. No, well, it's actually listed here. The world CAPM may not hold in all countries. I guess it's an international point. Like, it's the question of what the benchmark is. So, often with international investment, we use a world benchmark equity return. And then you could also use a world benchmark interest rate, which would just be like a capitalization weighted interest rate in different countries.
Does it depend on where most of the investment is coming from?
Yeah, absolutely. Well, it depends where most of the wealth is. So,
weighted
U.S.
and
would be,
U.S.
yeah, so, well, the U.S. is heavily weighted, 40%. And Japan is more and more weighted lower. Okay. Because even though it is the second largest, there's just, I think I've mentioned this before, a lot of cross ownership. Where one company owns a piece of another company, so you're double counting when you count up the value of the firms. So it's got even a lower weight than people think. But yeah, you know, it's the second largest weight nevertheless. So benchmark, other sources of risk, all these things could mess up the capital asset risk model. You got to be aware. You have to know the model, but you also have to know when it's likely to fail. It was almost immediate that it was going to be likely to fail if the beta has shifted. It turns out the beta doesn't change that much because it's unlikely the firm is shifting radically business model. But if it does, then you've got to adjust the beta. Okay, so all of these things you have to be aware of, and the second year course goes through much more detail on this. But this is a good helicopter tool. What about cross-sectional tests of the CAPM? And what this is basically, we've kind of done this. It says, well, if there's a bunch of securities with different betas, I would certainly hope that the high beta securities have a higher expected return than the low beta securities. So we could do a scatter graph. And the scatter graph would be on the y-axis the security returns, and on the x-axis the betas. And I would hope to see a positive relation. So I could just so if I put beta here, and then the actual performance. I kind of hope to see something like this. And if I pass a regression line through that, that's the security market line. I hope that higher beta stocks have a higher performance, or the model doesn't make that much sense. And that's what people actually tried to do. And to pass the regression line through this is this equation right here. So you regress the returns on the betas. And this coefficient here, gamma 1, you hope to be positive or negative? Positive. A higher beta means higher return. And this was first done by Black, Jensen, and Scholes in 1972. Black and Scholes done a lot for finance. Got their hand in asset pricing here. And what they did is they formed portfolios rather than individual stocks and ran this regression, and this is the results of their regression. Notice they get a positive coefficient on the beta, a highly significant T ratio. And the intercept is small, but it is also significantly different from zero. Is that good news or bad news for the model? It's bad news. The alpha should be 0, and it turns out that it's slightly higher than 0, but it is significant. So they found support. They called this support for the model, but the model doesn't hold perfectly. And they kind of said that, well, what do you expect? Right? It's a real simple model, and we can't expect it to perform perfectly. It provides a description of what is actually happening in the market. It's not a perfect description. Therefore, we should actually use this type of model.
What is the gamma zero that you talked about in the explanation?
Oh, that's simply the intercept. So this is a regression of the returns on the data, and there's a slope coefficient, the gamma 1, and the gamma 0 is the intercept. I could have called this any, A and B. That's better. Okay. So let's see. The last thing you should know about this. Be careful of this capitalized pricing model. In terms of what it means in terms of returns. I went through earlier, I said 10% market return with a beta of 2 means only on average that the excess return on the stock is 20%. And a favorite exam question of mine is goes something like this. The expected return on the stock is 13%. If we double the beta, that means the expected return also doubles. True, false, why? Takers? Yeah, so we've got an expected return on the stock of 13%, a beta of 1. That if the beta doubles, then we double the expected return. I hear a lot of falses.
Account for the answer, right? I mean, that's what we're talking about, the alpha.
Alpha is 0. Expected alpha is 0. So let's take the alpha to be 0.
We're talking about excess returns or just returns?
Returns. So I said the expected return is 13%, the beta is 1. Then if we change the beta to 2, the expected return, I guess, is 26%. True, false, why?
What should be false if, for example, a risk free is 3 and the excess is 10, then it doubles to 23, so 26.
Okay, so the key is that the model holds for so 0.13. In our example, you can just put some numbers in. 0.07 plus 1.0 times 0.13 minus 0.07. Right? So this is the beta. And if we double the beta, that's going to be 0.07 plus 2 times 0.13 minus 0.07. And this equals, what, this is 6, right? 6 times 2 is 0.12. Everybody got it?
If your alpha was 0, then it could be 0.07, right? The intercept would be double.
There's no alpha in this.
0.07 is the risk-free rate.
The risk-free rate. Okay, so the beta doubles. That does not mean the expected return doubles. There's only one situation where if the beta doubles, the expected return doubles. What's that? The risk-free rate is 0, and it's a trivial case. I don't want anybody to say that. Right? That's like in 1931, there was like 1 month where the risk rate was 0. It's just not a credible assumption to make. Okay. True if risk-free rate is 0. I've seen that before. So I'm not. No, okay. What else do we have here? Section 8 is supplementary. It gives you an introduction to what we do in the second year course, and also section 9 is supplementary. And section 10 just gives you some references as to where to look for multi-risk sort of models. So these models that are hyperlinked here look at more than one source of risk, like interest rate risk and other things, term structure risk. There's multiple discount rates they would use for different horizons. The term structure is also there, and it just basically gives an introduction to all this stuff. Okay. So this is probably a good point to take a 10-minute break. When we come back, we'll talk about performance evaluation. We'll really try to make it 10
Basketball player.
Let's talk about efficiency in capital markets.
Is it what?
Very much so misunderstood sort of concept, the idea of efficiency. And this is a concept that was kind of pioneered by Fama, who's a professor at the University of Chicago, and kind of is associated with the University of Chicago. Given that I'm a University of Chicago graduate, almost by association, a lot of people think that, well, if you're from Chicago or if you're taught by a Chicago person, then you must believe the markets are efficient. And that's pretty stupid because that is sort of a common view in the market by a number of people who, by the way, really don't understand the concept of market efficiency. Okay? And it's kind of obvious. As soon as somebody says that, and then might joke and whatever about it, as soon as they say that, you know almost immediately that they don't understand one of the most fundamental concepts. So let me make sure that you understand this concept of efficiency. First thing is that efficiency has to do with the speed and accuracy with which information is reflected in security prices. In a perfectly efficient market, news is released. It's immediately interpreted correctly by the market and instantly impacted into the price. So good news, the stock price moves instantly to a new high level. Okay? What it is not is kind of like a slow adjustment to kind of the new level. It might take days or weeks. And what it isn't is the market overreacting to a piece of news and overshooting the price and then having to come back down to the final price. So the overshooting and the slow adjustment are evidence of inefficiency. So the first thing that you need to know is that markets are inefficient. Okay? And it doesn't matter who says this. Chicago graduate Fama is my dissertation chairman. That doesn't really matter. So anybody there or Fama himself would agree with the statement that all markets are inefficient. Okay? Because in the strict sense, to be efficient, you have to instantly adjust to the information and correctly adjust. And that just never happens. So really what we're left with is efficiency is kind of like a relative concept. So it's a question of like, how fast does the price adjust? Or how much does it overshoot the true price fall? Okay, so nobody really believes in efficient markets that really understands what efficient markets entails. Now it turns out that some markets are more efficient than other markets. And we can make general statements like, I believe that the New York Stock Exchange is one of the most efficient stock markets in the world. That it is more efficient than, let's say, the market in Thailand. And the Thai market is more efficient than the market in Zimbabwe. Okay? So, these are my opinions based upon my experience with these markets. And I've got a lot of confidence in these opinions. So, but that doesn't say that the NYSE is an efficient market. It says that it's more efficient than some of these other markets. So it's a tricky concept, and it is kind of an extreme definition where price is immediately reflecting the information. Now, the other thing that's really difficult with efficiency is how to test for efficiency. So, you hear this sometimes. Well, this stock is trading for $40. It's really cheap. It's really undervalued. The market's really efficient with pricing this stock. You hear some people say, or people talk about something being undervalued. And, I guess that's a test of market efficiency, that you can take a look at these undervalued stocks and you can search to see how many stocks are undervalued and by how much. But there's a problem with that. And that is that you need to know what the true price is. So somebody tells me that, oh, this stock is really undervalued. I usually ask, well, what do you think the true price is first? And the second question is, where did you get that true price? What model are you using? And that's the key. So we need, in order to test for efficiency, you need, an obvious test is the deviation of the market price to the true price. That, if we had the true price, that we can look at all the stocks on the market and see if the deviation is small and hopefully zero on average, because there will be some fluctuation. But we need some sort of benchmark true price in order to execute the test. And that's very hard to do. Now, even though it's hard, it doesn't deter a lot of people like me from trying to test market efficiency. So we actually do have a model. Already, we've got a model. And the model basically tells us what the expected return is, and we can easily back out the price if we want to talk about it in terms of price. So I could actually go through, and I could, with the capital asset pricing model, I can calculate the true prices of all the stocks on the NYSE. And then I could take a look at the deviation of the true price and the actual price, and say something. So suppose that it's the case that I do that exercise based upon the capital asset pricing model, and I find that there's a systematic deviation between the true price and the actual prices. And I conclude that as a result, the market must be inefficient. Because the definition of inefficiency really is the difference between the current price and what it should be. So is there a problem with me making a conclusion like that? I go all this work of calculating the expected returns by the model. And then I look at the deviation between what actually is there and what was expected. And I conclude that the deviation is very significant, and therefore the market must be inefficient. Yes?
I mean, we just talked about all the assumptions in your model, how they're most often wrong.
So the model can be wrong. So therefore, it's real hard to draw a conclusion. So you can use a model, it gives you kind of the true price. You could find a deviation between the true price and the actual price. You could call that inefficiency. But somebody else could say, well, it's not clear that it's inefficiency. It's probably that the model you're using is really simplified and it just doesn't hold in the real world. So this is a classic problem in not just finance, but in some other sciences, where you're trying to test a hypothesis. And the hypothesis is the market's efficient. But in order to test that hypothesis, you've got something else going on, another hypothesis. And that is that the true price is governed by the capital asset pricing model. So it's impossible to say, according to this two hypothesis saying, that the market's inefficient. Because somebody could always say, well, the other hypothesis is the problem. It's called a joint hypothesis problem. Any questions, Paul?
If you find using a model an inefficiency, can you assume that at some point the market will correct itself and that you will?
But the question is it inefficiency? Or is it that your model's wrong? That you force the beta to be constant when the beta should be changing through time. So it's like a phantom inefficiency. So it says that the prices are too low, but actually if we used a different model with a beta that's shifting through time, then we get a different answer.
So right now there isn't an accurate model, is that what it comes down to?
Well, there's a number of different models out there. Some are better than others. And some of them actually, you can find inefficiency with one model that is reversed than the other. Yeah.
It seems that sometimes there are models which are let's take the Black-Scholes model as an example. And as you said, it mimics the market pretty well. Now, before the Black-Scholes model, there was certainly some sort of market in options. So, and I would imagine that because people didn't perhaps understand all the mathematics of it, that sometimes the expectations that people had of the returns of these would differ from the real expected returns. And that once the model was there, what I would expect is that the market kind of moving more towards the model prices. Because people said, oh, I see, that changes my view of the expected model. So it would seem in a case like this where, if you were Black-Scholes and you came up with this model and you hadn't told anyone about it yet, that you could then take advantage of that. Because
your model is the true model.
Right. Well, I mean, that's a concrete example.
Yeah.
We know that model is better than what was there before.
Sure.
And
So
it certainly happened in other types of assets.
No, absolutely.
So you see, I think, a trend toward market tightening. So I guess the real question becomes, how do you go about testing these hypotheses to find out if you now have more information than the rest of the market?
Yeah, and that's something I can't answer in a couple of sentences.
Exactly.
Right. But I did spend 5 years doing stuff like that. But the idea is that the model could actually help us, like the Black-Scholes did, to kind of tighten the distribution. Now, Black-Scholes introduced in '73, and the exchange-traded options also were introduced in 1973. So it's right when the option market opened up. It is way easier to price short-dated options with the Black-Scholes than to do equities. Okay, the Black-Scholes is like a premier model of finance, in that it works really well, and the variance of it can take care of a lot of the deviations. Whereas with equities, these are very difficult securities, very complex. They're not derivative, right? They're not. You can't form a portfolio of other assets that exactly mimic those equities. So this is a lot more difficult to do, and there's a lot more disagreement on what the appropriate model is. Okay? But it is also true that as these models come out, they help people think about what the price should be. But it makes it extremely difficult. It doesn't really help us. It makes it extremely difficult to test for market efficiency.
The other might be true as well, though, that when the model becomes widely accepted, it becomes self-fulfilling, so that the market actually then reflects the model rather than the model trying to reflect the market.
Yeah, could be. Right, so then it says like no way to test for efficiency then, right? Right, so it's adhering to the model, but what's the true price? So, like in a way, this talk about efficiency, well, like in a way, for me, it's not that interesting, right? I said I spent 5 years doing this stuff, so really interesting. I realize that now. Luckily, I was doing it in a way that immediately implied, like we were able to learn something from the model that we could actually use for asset management. So what I was doing was different than looking at the intercepts and some regression of the stock return on the market return. And What I was doing was, okay, well, given this model that helps me understand the complexities of how stocks and bonds work, can I use that in a forward-looking way to actually design a portfolio strategy? So it turned out, I guess I lucked out in that I had the right twist on this problem. But just, to test for efficiency, to me, just isn't that interesting. Like, in a way, you like to find situations where the market's inefficient, right? Like, some people hunt for inefficiencies. And that's okay, because that's where you make the money. But in the broad picture, it's it's better to be looking at this model to help us with actually investing our portfolio, the individual aspects of our portfolio. So there's all these like tests of efficiency, and I've listed some of them, and see what you think. These are, like terms that are coined by Fama. Weak form efficiency. It says no investor can earn abnormal returns by developing trading rules based upon historical price or return information. So the intuition here is, well, yesterday's stock return, you've got that information. Surely you can't take that information and design a trading strategy to make really large returns. Because that information is really cheap. It's like the price of a Wall Street journal. Everybody's got that information as to what yesterday's return was. It's really unlikely that you can develop a strategy to make a large profit based upon information that's so cheap. Okay, and they test this with looking at autocorrelations. So you just take the autocorrelation of the returns. The semi-strong form says, well, there's no extra profits that can be made by trading rules based upon any publicly available information, including stuff like heard on the street. And people say, well, heard on the street, I know that it has an impact. That there's a company that's featured could go up dramatically or down dramatically, right, as a result of that sort of play in the press. But the question is, can you earn a return on it? So people read the Wall Street Journal in the morning. When the market opens, the price is adjusted already. You try to get in or out, it's unlikely you're going to make a profit. Okay, so what this is not saying, this doesn't mean the herd in the street has no impact on stock price. It certainly can. It can dramatically affect the stock price. But is there a trading strategy based upon this information and I can make extra profits on it? And the answer is probably not. There might be certain situations, certain recommendations that you might make something on, and that could be by luck too, or something else happening in the market. So the semi-strong form says, well, any publicly available information is unlikely you're going to make extra returns on it. And the last version, the strong form, says you can't make any profits based upon any information, and it could be even inside information. And that doesn't make any sense, right? Because I know if you've got illegal inside information, then in the short term you can make some money. But of course, if you're in this course, you don't just look at the short term. You do the present value calculation, right? The short-term profit, and there is a probability of a pretty large, longer-term cost. Okay. Jail, reputation, stuff like that. It all gets back to me too, so it's like a negative externality for. So yeah, but nevertheless, this, to me, is a category that isn't that interesting. That yeah, it's true if you have inside information, then you can make some money. So what?
But isn't there something between private, like inside information and public information?
That's why I said illegal.
I mean, there are people out there on Wall Street who are studying these industries and these companies who have more information, and they're talking to the companies on the phone.
Right.
They have more information than we do, or whoever else is reading the Wall Street Journal every day. So there is something between illegal and public.
Yeah, let's be careful about that. I think I did say illegal inside information. Okay? So there's legal inside information also. So there's insiders of the firm that have inside information. And you can actually, there's services that publish the trades that are made by the insiders. There's certain windows when you can trade. You can't trade all the time if you're an insider. So some people have actually gone to the exercise of tracking the insider trading and trying to develop a portfolio strategy based upon the legal inside trading of other people. And it's, in my opinion, unimpressive given the work that went into actually get the results. That not much is gained in that investigation. Okay, so even the legal insiders, when they actually trade, it's often just for liquidity, so you need some cash or whatever, though there are exceptions that they're trading on some fundamental inside information that other people potentially could benefit upon.
But I'm thinking about the guy who's sitting down on Wall Street whose job is to study the electronics industry and follows these, whatever companies. He's a better source of information and therefore might be able to capitalize better than other people.
Not everybody has, it might be public information, but not everybody has or takes the time to have access to that information.
Right.
So we don't all have the same information, even if it is all public.
Okay, I agree.
Also interpreting it correctly.
Interpreting, yeah.
I used to work for attorneys whose job was, and my job was to gather this information about companies that were in play, mergers and acquisitions. And the attorney that I worked for made the clear distinction that it's publicly available but not widely disseminated. So my job was to call and get information, and according to this attorney that I worked for, and I believe him, I guess, because he's an officer of the court, he'd say that if someone would tell you this information, then it's public information, but it doesn't mean that they're telling everybody. They might be telling only you, and that counts.
Except, well, I'm no expert in the law, but I'm not sure about that.
Well,
It depends who's doing the telling.
well, yeah, and what
It's an insider of the firm.
and what he or she is saying, but
Yeah.
but essentially, it's if it's the information's out there, it's just not what it is.
Yeah. Well, I think this is kind of the point that there's information that's out there, but there's like two distinctions. Like not everybody potentially got access to that information, and then there's the way that people interpret that information could differ. Right? So let me kind of refine this, and what I'm not saying, that these are just like arbitrary categories, right? What I'm not saying is that you can't be smart and make some profit, right? Because like the whole idea of the market is that people disagree. With no disagreement, there's no trading. I guess there's some liquidity trading, that's it. There's fundamental disagreement in the market. There's information out there, and even if we assume that everybody's got access to the information, different people are going to interpret it differently. And look, I don't have time to follow every single stock. I've got teaching, research, administrative duties. You've got, whatever job search plus, all your studies and whatever else going on. Okay, you have time to track all these stocks. So you might rely upon somebody who specializes in these individual securities. That's possible. Now, my experience is that you can't make any abnormal returns based upon these so-called experts that study the individual securities. That, if anything, they're good at identifying firms that are with negative recommendations, not positive recommendations. Okay. So it's real hard to use that, but this is not to say that you can't make good money based upon an interpretation of the information that's higher quality than somebody else's. And my whole second year international investment course is focused on that one theme. The theme is basically, here's a group of people, everybody here is well above the average in terms of the level of sophistication for investments in the economy. Okay? You should be able to make money. Okay? Because there's going to be people that disagree with your view, and you're going to be right more often than them. So So you're going to trade with these people. You don't identify, this one bad trader just in the market that's going to happen. So the skill, the skill in this is to be able to take this complex information and to synthesize it in a way to maximize your hit rate on trading. And we do that. We do that with quantitative tools in the second-year course. Where we say, well, there's all this complex information. How do you weight it and summarize it to get a signal for a trade? And you can do that in your head, or you could use multiple regression analysis. I use a regression analysis. I can't do regression in my head, right? So there's ways to use some of the tools that you do in statistics to kind of optimize, to squeeze out of the information the best possible signal, to put a complex set of sometimes conflicting information together to maximize the chance that you're on the right side. It's nothing to do with efficiency or inefficiency. But the market is inefficient, according to what we said right at the very beginning. There's some people that are going to be smart traders and some people that aren't. Just make sure that we're on the smart side. So, I think that it's as simple, and to talk about it in terms of efficiency or inefficiency, to me doesn't make any sense. So hopefully that makes sense to you. Let's just make some money, right? The market's inefficient, fine. Maybe I'm going to make it more efficient by my trading. That's possible too. That's okay also, I guess. Okay, well, in terms of what people do, the weak form tests are just regressions on lag returns. Okay, so this is this delta is just what's known as an autocorrelation coefficient. And you do this for IBM, and the coefficient is basically 0. So I actually did some of these. And basically 0. There's no significant T ratios. And there's also more complicated rules, technical trading rules. Instead of just looking at the past return, you look at a function of moving averages or stuff like that. And that, well, in the second year course, we actually try to see if that works, the technical rules. So what we do is we take their predictions and load them into a regression to try to predict the returns. You take the technical rule, which is sometimes a long-term moving average, and the intuition is you have the data, you put a long-term moving average through it, which is nice and smooth, then you put a shorter-term moving average through it, which is a little more variable. And if your price goes in the short-term moving average above the long-term, then the idea is that it's going to be pulled back down to the long-term. If you go below the long term, you can be pulled back up. So it's an immediately implementable trading strategy. So you put the signals into a model, and almost always coefficient 0. That doesn't work. Yeah.
So when you get autocorrelation equal to 0, is that just saying that the return in the previous period is not an indicator at all?
That's correct. No indication.
When you talk about moving averages not working, crossovers, that's, what do you mean by that? And I've seen individual commodities where it has worked.
Yeah, sure. If I apply this over 300 commodities, you get one that works. Okay. So historically. In the future, it's a different story. Again, it's just statistics. Yeah.
Can I just ask, what's going on at the bottom of this chart? It looks like there's almost 1 per dollar.
These numbers are incorrect. These look like the betas. I think I mixed up the charts when I put them in the HTML. These numbers are accurate right here, but I think the 5-year numbers are the betas by mistake. Okay, so I'll fix that. the original. Yeah, the coefficient overall is 0.08, and in the recent 10-year period is 0.05. Not significantly different from zero. Look at the R squared. If this is a good prediction regression, well, hardly. Zero R squared is not too impressive. There's no information to be used here that can predict the return. And this is true for almost, well, for most securities on the NYSE. Okay. What about mutual funds? Okay, now this is an interesting group because it's like their job to kind of figure out what to invest in. Large staff of people. You can say that you've got your schoolwork and job search and stuff like that. You don't have time, but mutual fund people are actually paid to do this job, right? It's their job to specialize. Okay, so they have got the possibility of making the phone calls, going to see the CFO, analyzing all of the data. Maybe this is what we want to do. So we want to farm out to these people that really know what's going on. And there's various different styles of mutual funds, and I've put some of them up here. And these are some categories, like Morningstar categories. Morningstar is available in the library. It's a service where you can get all sorts of statistics on mutual funds, CD-ROM. And what I've plotted here is beta versus the style. So aggressive growth has got the highest beta range, and the green bar is the mean beta. Growth income, income growth, balanced, and income. So basically what's happening here is that there's a relation between style and risk.
Just the line, the average?
Yeah, the green line's the average. Yes.
Why would a mutual fund company recommend to someone with a long-term horizon like ourselves that we hold anything that is on the lower end that's balanced or income? Why wouldn't, if we have long-term outlooks, why wouldn't we want to go for high growth?
The only reason the mutual fund would do that is because the salesman is being compensated for selling this income fund greater than anything else. And also the salesman might genuinely not understand one of the most rudimentary things that he is.
So there is no, I mean, I can't see any reason why someone our age would do anything but person.
Yeah. Absolutely.
The only reason I've heard is that it's your emergency fund in case something like a recession, you lose your job. I've heard that you want to keep this something more stable.
But not for everything overall.
Yeah, no, most of your should be in the growth category.
Yeah, so it's like a good case to be made for some insurance. Like you don't want to put everything in that category, but just go for a money market fund. That doesn't make any sense. Yes.
Morningstar gives 5 stars, 4 stars. Does that mean the beta, they got the excess return over beta?
Simple. And you get the betas right out of the alphas, and the betas are all there. This is volatility and style, and there's kind of not as sharp of a relation, but there is a relation. It turns out that the most volatile funds are also the highest beta funds. This is not always the case. Let me emphasize this, that it's not always the case that there's a relation between beta and volatility. And I give you a counterexample where you had that 50% volatility stock with a negative beta. So that can happen. But when we look at portfolios of stocks, like mutual funds, then often there is a relation between volatility and beta. And if we look at performance, kind of get the same graph, that higher average performance for aggressive growth than, let's say, balanced or income. This kind of supports our idea that the higher risk is being compensated by higher expected returns. So it's very much consistent with the asset price index theory. So I guess we need to know what to invest in, and we need to evaluate the performance of these funds. So we've got one measure already, and that's the alpha, sometimes called the Jensen's alpha, because Jensen was the first person to actually propose the alpha as a measure of performance. When Sharpe published the capital asset pricing model, there's no alpha. the model. So Jensen said, well, let's run a regression, look at the alpha of the fund, and to see how it did. And we've already talked about the alpha being the actual performance minus the expected. And graph didn't turn out, but that's okay. Let's go to the more recent graph. This is some of my work. Jensen's graph goes through 1965 or something like that, and mine is a little more recent. And let me explain what I did here. I picked 74 mutual funds that survived from 1968 to the end of 93. But you know there's like thousands of mutual funds. And a lot of mutual funds go in and go out. Stay for a short period of time. They underperform and they're gone. So this is a really biased sample. Sample of long survivors in the market. Okay, so you expect the performance of these people to be quite good. So what I did is I just plotted the alphas. Okay, and this is a histogram of the alphas, and the way to read this histogram is like that 26. And let's just look at the blue bars. The blue bar is just a cap M alpha. And I guess we'd be looking for the distribution of alpha, and we look at the alphas below 0, the alphas above 0. Notice that more are below 0 than above 0. And we can also look at the T statistics on the alphas. And the green bar are the T ratios for the alphas. Notice that of the 74, there's only 9 that have a T statistic greater than 1.5 on the alpha. So if we even say that 1.5 is significant, which I'm not sure I want to do, I'd probably say 2. But being real conservative, saying that a T ratio of 1.5 means significant performance, there's only 9 out of 74 over this sample that did better than in terms of risk-adjusted benchmark. Now, given that this sample is a biased sample in favor of higher performance, you can imagine what this looks like with all the mutual funds. So, if you look at all the mutual funds, the alphas are almost always on the negative side, or indistinguishable from 0. Okay. Notice also this, I'm not telling you what this is, this R star is a different benchmark. It's a benchmark that Bonsall and I proposed using. And we think it's a better benchmark than the CAPM benchmark. Notice there's only 2 funds that have significant alphas with respect to our benchmark, a broader benchmark. So it's very discouraging that given the survivorship bias that's in our sample, that these funds do so poorly. And basically the message of this is that mutual funds do poorly.
So who are the 2?
Oh yeah, that's secret. You have to pay $5 for the paper. Okay, now the other thing is kind of like, we know that there's been some great winners in the mutual funds, right? Like Fidelity, Magellan, right? A great winner. But you have to be real careful, okay? Because you can always pick out high return. Given like 3,000 mutual funds, if it's just completely random, there's going to be a number of really great winners over the years. I'm not saying that it's pure luck for that one, because I think there is some skill in terms of picking stocks if you're really good. But you just have to be careful. That, and also, if you look at the performance over the past, it's not necessarily indicative of the future. You don't agree with that?
No, I was just laughing at the disclaimer on the stage.
Yeah. But we'll talk about the persistence, but there's some other questions.
But it still doesn't mean it's a bad investment. I mean, just because there aren't ones that do significantly better than the average, it's still, the average investor putting money in there is still doing well, and still getting returns on their money that's attractive.
If you get a negative alpha, then you can do better with something else.
Simplification market.
That's true. So now we actually got a good reason for investing in mutual funds, that I can't do a larger portfolio. I've got a limited amount of money. Like, I'm invested in mutual funds, mainly because I'm forced to for my pension. I mean, choice. But if you do have a limited amount of money, then yeah, it makes a lot of sense to buy into a diversified portfolio. That's a good reason for doing it. You want to pick one with the smallest possible negative alpha.
You're not going to outperform doing it on your own.
Well, with negative alpha, I can definitely beat.
If you know the alphas, you can. I guess part of your point is if you know the alphas, you can outperform.
Yeah, well, if I know they're going to consistently be a negative alpha, I can definitely outperform them. Yeah.
Can you tell me the best thing I could do is buy a fixed fund, S&P 500 index?
No, I'm not saying that at all.
Well,
Actually, an index fund, they buy the S&P 500, right?
If we're saying that's the market, that's going to be most mutual funds.
Oh, okay, that's true.
So if you're not going to be an active investor, that's probably a good passage.
If you want to, well, I'm not even convinced of that. So the index fund, you buy basically the S&P 500 stocks. It turns out that that's, probably one of the safer things because it imposes this real discipline on the managers not to get into trouble. It's like a simple rule. You buy the S&P 500 stocks. That's it. Right? So they're not taking a flyer on this and that and buying and selling and churning for no reason whatsoever. Okay, so, but even if you buy the S&P 500, you've got all these transactions costs, and you've got the limos and dinners and employees and computers and whatever.
But that's present in any other mutual fund. So it's going to be all but two mutual funds. Is that what you're saying?
Well, I'm saying that if you've got a choice between some of these other ones and an index fund, if that's it, then I agree with you that probably an index fund would be better, but I've got a broader set of choices.
If you are working with the assumption that with a smaller amount that a mutual fund could still be a good investment, then given a prospectus, then what should you be looking for to make sure it's a good decision?
Okay, well, we can talk about that. Okay, I'm going to talk about that in terms of persistence. So one thing we can look at is look at the alphas, right, and see if the alphas persist. So is it the case that a positive alpha is repeated by another positive alpha?
And that, do they specifically list alphas within them? Or is that something you
Not
need to look at?
necessarily, no.
Okay.
But we can easily get that off Morningstar and the library.
I just had a question. I just want to make sure I'm clear. When you're saying past performance, you feel is not indicative at all of mutual funds?
Well, I haven't shown you the results on that, but that's going to be the case. Okay? Let's wait on that one, okay? Because I do have some empirical results on the performance. Yes?
How does it compare if you have long-term futures on the S&P 500 versus a fund on the S&P 500 in the long run?
So if you're smart, you're going to do a managed futures portfolio. You want the S&P 500? Fine. Then just put the same amount of money that you would have invested in the index fund into a money market account and trade the appropriate number of contracts. And as you get into the expiration month of the contract, just get out and go into the next contract. Just keep on rolling it. Transactions costs are minimal because you're doing the futures. And you do need at least the amount of money for one contract. You want to adjust your leverage up or down, no problem. You want whatever level of volatility, you can easily do that with the futures just like we did in assignment number 3. So that to me is the benchmark. I think that's a smart benchmark. But we do need that amount of money to do that. And those of you that did the 500 futures realize that that's a fair bit amount. At the 100% margin on the S&P 500, you need some money to do that. Well, one of the things that mutual funds try to do is is to time the market and select superior stocks. So this is just an example of excess returns with a positive alpha. And let me show you market timing. This is an example where the fund is switching into high beta stocks when the market's going up, and switching into low beta stocks when the market's going down. And I kind of put a curve through that. That's the green curve. But just the usual regression is going to show that the alpha is positive. There's one thing you should be careful about using the alpha is it might give you the wrong answer. So this is an example of another market timer who is totally out of the market when the market as a whole goes down. It just puts the money in treasury bills. And as the market goes up, weight more and more in the high beta stocks. So you still get this curvature, but when we run the regression lines through the data, the alpha is 0. So this person is said to have neutral performance when actually the performance is better than neutral. So market timing introduces a nonlinearity. You can see the nonlinearity in the curve. And anytime you try to fit a line where you should be fitting a curve, then you can get into trouble. So this is the idea of market timing. Let me briefly go through the other measures of performance. The Sharpe measure we already did, so it's expected excess return divided by standard deviation. And I said that that was only okay if it's mutually exclusive investment opportunities, because the risk is not standard deviation. The Trainer measure, which is the expected excess return divided by the beta, that I think is better than the Sharpe measure because the denominator is the beta. Okay. And that basically, what you're doing there is, if this is a scatter of excess returns in beta, you're picking the stocks that have the highest slope from the 0 point intersecting one of these dots. They also drew the security market line on this graph. So you're picking the stocks that have the highest possible excess return per unit of beta. Okay, so that's a Trainer measure. There's also a measure that's got my name. What this idea is, and let me tell you what it is. It's very simple. So what I do is, you give me a mutual fund that's got a certain volatility. And what I do is I create a portfolio of managed futures, S&P 500, and money market that delivers exactly the same volatility. So just change the leverage, whatever, to get exactly the same volatility. So you tell me the mutual fund volatility is 20%. I'll deliver a portfolio of S&P 500 money market that's got exactly 20%. And then look at the return of the managed futures portfolio. Look at and basically subtract the return of the mutual fund. It's real simple. I refer you to the article in Forbes on it, which is called the Graham-Harvey measure, which is kind of nice. And they actually find that it's got some advantages, but it's real simple and intuitive. We've also got another measure that, instead of looking at standard deviation, looks at beta, like the Trainer measure. And actually, what we did is we applied this to investment newsletters, and I'll talk about that in just I got 2 minutes left. Okay. Let me show you the persistence numbers first. What this graph says that if the mutual fund did better than expected over the past year, what are the odds that it does better than expected in the next year? And it turns out it's 50-50. If it does well over the past 2 years, what are the probability that it does well in the third year? It's 52%, insignificantly different from 0. And it goes up to 55, then you have 5 years of outstanding performance in a row. The probability of the 6th year is less than 50%. All of these are no different than a coin flip. So it suggests there's not a lot of evidence of persistence. Now, some people redid this exercise and actually looked at performance, positive performance and negative performance. And it turns out that I can say with a lot of confidence that mutual funds performance actually persists. And the reason is not the positive performers, it's the negative performers. If I redo this with negative performance, then these numbers dramatically change. So if you have 2 years of negative performance, the probability that the third year is negative is like 75%. So the lesson here is that if you're really bad in managing a mutual fund, then you probably continue to be bad until you have to drop out. But if you're real good, then it's like a coin flip as to what's going to happen next time. Because the good performance doesn't persist. Okay? So it's kind of like, in a way, a little discouraging. Overall, the performance of the mutual funds is, I think, I could say, given that I've looked at the data, poor. Okay? The bad funds persist in being poor. So what does that suggest for an investment strategy in mutual funds? Say it again?
Avoid high expense.
How do we make money off of this?
You avoid the ones that, you only go with the ones that have historically good results.
Well, historically good is just a coin flip.
But it keeps you making, you go with the bad ones.
Oh, the bad ones, I can avoid that. What else can I do? Short. So we can't short the mutual funds. What else can we do? Well, mimic portfolio is real difficult because you don't know exactly what they're doing. Plus, they've got, some of the bad performance could be the overhead, right? So what else can we do? We can't short, we can't mimic. Say it again? We can't switch funds. What else can we do?
Puts?
No puts. No options on funds. We want to start a mutual fund. It's a great way to make some money. Okay.